Assalamu alaikum warahmatullah. In this video, I'm going to introduce options as an important class of derivatives contracts. In this chapter, we will discuss the mechanics of option markets, and we will see some of the features or characteristics of options, and then we will see some securities that involves options. Now this chapter is important because it provides the foundation to later chapters in which we will see trading strategies that involves options. We will see also some the relationship or the factors that affect option prices, and then we will introduce two of the important option pricing models that were crucial to advance our knowledge and understanding of how options are priced. So let's start by doing a quick review of what we have learned in chapter 1. So in chapter 1, we learned that there are two major types of options. One is a call option, and a call option gives the holder the right to buy. The other is a put option, which gives the holder the right to sell. Now, in terms of when the holder can exercise the option, we have two major types. Now, there are other types also, but the most common and popular types are the European option and American option. The European option gives the holder the right to exercise the option only at the end of its life or on its expiration date. The American option gives its holder the right to exercise the option anytime from the time it's initiated until its expiration date. Before we proceed, I would like to share with you one of my talents. I also have talents other than teaching that will help you understand the relationship between the two parties in any option contract. Let me introduce to you Mr. M and Mr. S. Mr. M is the buyer of the option, or the party who took a long position, or the holder of the option. So all these names refer to the same person. Mr. S is the writer of the option, or is the seller of the option, or the investor who took a short position in the option. Now, why it is important to differentiate between Mr. M and Mr. S? Well, because in terms of when the cash flow takes place and what happens later on depends on the position of each investor. Now, for Mr. M, the buyer of the option, at the time they signed the contract between S and M, they signed the contract, the buyer has to pay to the short investor or to the writer of the option the premium. Now, and this applies whether we are dealing with a call option or whether we are dealing with a put option. Now remember, because the Mr. M, the buyer, paid the premium, he has the right. So he has the right to exercise the option, but not the obligation. Now, if he chose not to exercise the option, then Mr. S will do nothing. But if he chose to do if he chose to exercise the option, then Mr. S, the writer, has the obligation to execute the transaction. Now, as we learned in forwards and futures, there are two ways to settle an option. Either an option could be settled financially or it could be settled physically. Now, when the option is settled financially, when the investor or the buyer of the option, the holder of the option decides to exercise, then the writer of the option will pay the payoff. Now, is there any uncertainty about the premium when they sign the contract? No. They agree on the premium. Mr. M will pay to Mr. S the premium. The cash flow is realized by Mr. S, and that's it. But are we sure that Mr. M will always receive a payoff? No. Here comes the uncertainty. We are not certain about this type of cash flow, but we are certain that the buyer will pay to the writer or the seller the premium. So here for the premium, there is, once it's paid, there is no uncertainty about it. And the only uncertainty comes from whether or not there will be a payoff. Now, a payoff will exist only if the option is going to be settled financially. If the option is going to be settled physically, then it depends on the type of the option we are dealing with. If we are dealing with the call option, remember the call option gives the buyer the right to buy. It gives the holder of the option or the investor along the right to buy. Now, the right to buy what? To buy the underlying asset at a certain price called the strike price on or before a certain date. So Mr. M and Mr. S signed the contract and they agreed that they will enter into a call option. So M paid M to S, and later on Mr. M decided that it is in his interest to exercise the option. So he will notify Mr. S that he is going to exercise the option. So he will pay the strike price and receive the underlying asset. Why he is going to pay the strike price? Because in the call option he has the right to buy, and when he wants to buy, he has to pay the price for the thing he's going to purchase. So when he enters into a call option, he guarantees that he will buy the underlying asset at this strike price. So he will pay the strike price to Mr. S, and Mr. S will deliver to Mr. M the underlying asset. Now, if you are dealing with the put option, the same thing. Mr. M, when they sign the contract, has to pay to Mr. S the premium. Now, later on, Mr. M decided to exercise. Remember, he has the right. So he chooses whether or not he wants to exercise. So he decided to exercise. Now, what's the definition of a put option? It's the right to sell. So which means that when Mr. M exercises the option, he will deliver the underlying asset. When you sell something, you deliver an asset and you receive the selling price, right? So that's what happened here. M will deliver to S the underlying asset, and S will pay to M the strike price. Again, you will notice that whether we are dealing with call or put options, we always have a buyer and we always have a writer. The writer always receives the premium. The buyer or the holder always has the right to exercise. Now, an important element in any option contract, in any call option contract, is that it gives the holder the right to buy. Now, to buy the underlying asset at the exercise price, which is called the strike price, on or before the expiration date. Now, it depends, of course, whether the option is American or European. Now, when it makes sense for the holder of the call option to exercise, if the market price of the underlying asset is higher or smaller than or lower than the exercise price. Now remember, we are here looking at the issue from the perspective of a person who wants to buy. And for a person who wants to buy, when you want to buy something, do you want to pay a higher price for it or you want to pay a lower price for it? Of course, you always want, if you are a rational person, you want, for the same thing, you want to pay a lower price for it. Now, if you observe that the price of the underlying asset is higher than the strike price, then here it makes perfect sense to exercise because you want to buy at a lower price. Let's denote the exercise price by K and the market price or market value by S. So the holder of the call option will only exercise if S is greater than K. So he will exercise. Okay, if S is less than K, will he exercise? Assuming that you are a rational investor, it doesn't make sense to you to pay a higher price for the thing you want to buy. You can buy it from the market directly, right? So you will not exercise here. So under this scenario, no exercise. Now, the purchaser of a call option is hoping the stock price will what? Will increase or will decrease? I will leave this for you to contemplate. Okay, how about put options? Put options give their holder the right to sell what? An underlying at a specific time, which is at a specific price, or which is called the exercise price or the strike price, on or before expiration date. Now, in a put option, you are taking a position of someone who wants to sell. And if you want to sell something, do you want to receive a higher price for it or a lower price for it? So when you will exercise a put option, again, we have K and we have S. If S is less than K, will you exercise? Well, assuming that you are rational, yes. Why? Because if you exercise, you will receive a higher price for the thing that you will sell. So you will only exercise when S is lower than K. So here you will exercise. If S is greater than K, will you exercise? If I'm a person who wants to sell something and I want to receive a higher price for the thing I'm going to sell, then I will not exercise and I will sell at the market price directly. So here we will have no exercise. The purchaser of a put option is hoping the stock price will what? If we are dealing with options on stock prices. Also, I will leave this for you to think about. Now, the writer or the seller of options, the only cash flow that he will receive is the premium income. So the premium that the writer receives is considered as an income. Now, if the holder exercises the option, the option writer must either settle physically, as I showed before, or must settle financially. So in a physical settlement, the short party will make delivery of the underlying asset. So he will deliver the underlying asset, or he will take, if we are dealing with a call, or he will take delivery of the underlying asset if we are dealing with a put option. If the option is settled financially, then the short will pay the payoff. Now, how we determine the payoff? It depends on the type of the option we are dealing with. So if we have a call option, so for a call, the payoff is equal to the maximum between S T minus A or 0, assuming we are dealing with a European option. For a put option, the payoff is the maximum between K minus ST, and we will read this again later. What are the possible positions that involves options? Well, there are 4 major positions that we can take in options. What are these positions? Well, long call, short call, or long put and short put. Let's look at a long call. Now, in a long call, you observe that, let's assume that we are looking or examining a European call option, and this graph here, or this chart here, or this diagram here, shows the profit from buying one European call option. Now, what is the major elements or major characteristics of this call option? The price or the premium for the option is $5. The strike price is 100, and the option life is equal to 2 months. So here we will see what will be the investor's profit at different ranges of prices on the expiration date of the option. So we will compare what is the stock price, what is the underlying price at time T, and what will be the profit or loss for the investor. Now, since the strike price is 100, now for the option holder, it doesn't make any sense to exercise if the option is below 100. There is no point of exercising the option, because if you want to buy, you can easily get buy the underlying from the market directly. One will say, okay, why cannot I don't want to buy, but I want to get the payoff. Well, also the payoff depends on the market price and the strike price. If you take the difference between the market price and the stock price, it will be negative, which means that you will pay instead of receiving, which is not going to happen in options, because there is nothing that can force you to exercise. Now, if the price is below 100 and it doesn't make any sense to exercise, then you have lost the premium you paid. So the amount you paid as a premium is a sunk cost. You will not get it back, so you just have to accept that it will be lost. Now, at any price above 100, you will find that as the price as the underlying stock price increases, the profit of the long investor will increase. Why that's the case? Well, because remember, you have the right to buy at 100. So at any price above 100, you will always have a chance to buy at a lower price, sell at a higher price, and make a profit. Okay, what is the break-even point for a long call position? Well, it costs you 100 to buy the or it will cost you 100 to buy the stock if you exercise. It costs you $5 to pay for the premium, so it will break even when you receive 105 after exercising. So at 105, the profit will be 0, or your break even. Okay, now it's important when we examine profit diagrams or payoff diagrams is to ask ourselves what is the upside potential or downside potential, and what is the upside risk or it is the downside risk. For the long call here, is there any limit on the profit that the investor can receive? Well, is there any limitation on what by how much the stock price can increase? At least from a theoretical point of view, there is no limitation. The stock price can increase as much as high as possible, but there is no limits on what will be the stock price. So we can see here the upside potential is unlimited. Okay, how about the downside risk? If the stock price went down, well, my stock price or my maximum loss will be the amount I paid for as a premium. So the downside risk is limited, but the upside potential is high. Okay, how about a short call? Let's look at the profit from writing one European call option. Same option as before, the same price and the same strike price. If the price went down of the underlying asset, then the counterparty will not exercise. And since I am a short investor in this position here, which means I'm going to receive the premium. So if the counterparty did not exercise, I will keep the premium and I will enjoy it as a revenue that I make out of this transaction. However, if the stock price increases, then this means by every dollar the stock price increases, my losses will increase. Why? Because I have the obligation to sell the stock price, to sell the stock to a counterparty at a price of 100. So if I don't own the stock, I have to buy it from the market at a higher price, sell it at a lower price, and incur a loss. Now, if I already have the stock, then it's a different issue. We will discuss it in chapter 12. But here, assume you don't have the stock. So to meet your commitment, you have to buy it from the market. And when you buy it at a higher price and sell it at 100, definitely you will incur a loss. Okay, how about the potential for this position and the risk? Now, the downside potential is limited. So the maximum you will earn from this position is $5. But the maximum you will lose is unlimited. At least from a theoretical point of view, the level the price can increase to is unlimited. So if that is unlimited, then also the loss of the short call investor is unlimited. So you can see that writing a short call is not an investment with low risk, or not a trading strategy with low risk. Okay, how about now put options? Let's look at long put. Now, assume that we are looking at a European put option with a price or a premium of $7 and a strike price of 70. Remember, the put option is the right to sell. So it will make sense to exercise a put option only if the stock price went down. So as the stock price goes down or decreases, then the profit from a long put option will increase. Why? Because, for example, a price of 50, you can buy the stock at 50, sell it at 70, and you make a profit. Again, here we are assuming you don't own the put option, but you entered this position for speculation. Okay, let me ask you this question. At what price the long put will break even? So remember that when you have a long put option, you will receive 70 if you're going to exercise, and you paid 7. So at the price of 63, the long put option will break even. Because if you bought the put stock at 63, you paid $7 for buying the put option, and you received 70 from exercising the put option, so net will be for you 0, a net profit. If the price decreases, then you will get a higher or you will receive a higher profit. Now how about the upside potential, or what is the risk and potential for a long put? We observed that as the price increases, what happened to the profit? So the profit will increase until it reaches a certain point, and then it becomes flat. What does this mean? It means that the maximum you will lose in a long put position is the premium that you get. So it has a limited risk, okay, if the prices increase. If the prices decrease, how about what is the maximum profit that the investor can receive in a long put option? Well, to answer this question, let me ask you, what is the maximum, or what is the lowest price a stock can decrease to or can fall to? Can the stock price become negative? Well, the answer is no. And the reason for this is why. So we agree that the price of the stock cannot be in the negative territory, for example, -5 or -10. Why? Because it means that you owe to others $5 if you have a stock in the company, or you owe to others $10 if you own a stock for some other people. And we know that in the corporate form of business, there is a limited liability for shareholders, which means that the maximum that they can lose is the amount that they have paid to invest in the company. So if there are debt holders or bond holders who require some to get back the funds they lent to the company, and the company's funds are not sufficient, then nothing can happen to the shareholders. Because of this feature of stocks, the lowest price a stock can reach to is 0, which means that is there any limits to the amount of profit a long put option investor can receive, or it's unlimited? Since the lowest price is 0, then there is a limit on the stock, or there is a limit on the profit of a long put position. And the limit is when the price goes to 0. Okay, now let's look at a short put position. Again, same option and same premium and same strike price. Now, the investor who takes a short short position in a put option will receive the premium of $7. So if the stock price increases, then he is going to keep the premium because the counterparty or the long investor will not exercise. Now, as the stock price decreases, then since the long investor has the right and he has the obligation to enter into the transaction with the long, which means for the short investor, if the long wants to exercise, then he has to buy the underlying asset from the long. Why? Remember, the put option investor or the put option holder has the right to sell, which means the short investor will buy. Now, he will buy at what? He will buy at 70, and then assuming that he has to liquidate his position, he will pay at 50, sell at 50 or sell at 40 to get back his cash. So he will incur a loss. Now, is there a limitation on the profit that short investor will receive? Yes, the maximum profit he will receive is the premium he got from the holder of the option or the buyer of the option. Is there a limitation on the losses for a short put position? Yes. The limit is when the price of the stock comes to 0, in which the maximum loss is going to be 63. Why 63? Remember, because he is going to buy the stock for 70 and he received $7, so net amount he lost is 63. Now, what do you notice the relationship between the short and the long? So for the put, this is the short, this is the long. Short, long. Short, long. How about the call? Long, short, long. Short, long. You observe that the loss of one party is the profit for another party. So here at the price of 80, the long lost the premium of $5. The short received a premium of $5. So you can see that it's a zero-sum game. A loss of one party is a profit for another party. Here we will observe the payoffs of different option positions. Now, in a payoff, when we look at an option payoff diagram, we ignore the premium. So we just look at the difference between the strike price and the price of the asset at maturity, ST. Now, what is this position here? Okay, this is a long call. How about this one? This is, if this is a long, and this then should be a short call. How about this one? This is for this payoff is for a long put, and this payoff is for a short put. There are now we next turn to assets that are underlying for exchange traded options. So there are options on different types of underlyings, but the major types of underlyings are stocks or and ETFs, sometimes called ETP, so exchange traded products, and there are options on foreign currencies. There are options on stock indices. There are options on futures, and there is also options on interest rates. Now, the major markets that trade options on stocks is the Chicago Board Option Exchange. The Chicago Board Option Exchange, or the CBOE, is the largest market or the largest exchange that trades options. And you will see that there are a variety of options introduced in the CBOE. The major ones are US options on stocks and on stock indices. Also, they introduced an option on the S&P 500 volatility. So it's so options on now a different class of underlying, which is a variable, not an asset anymore. The major market that trades options on foreign currencies is the Philadelphia Stock Exchange, which was acquired by NASDAQ in 2007. So the Philadelphia Exchange specialize in offering or one of the major products that they offer is options on foreign currencies. For stock indices, the CBOE, and also for ETFs, is the largest market that offers options, exchange traded options. The Chicago Mercantile Exchange, or the CME Group now, offers options on futures and also offers options on interest rates. Now, there are links to these websites. If you are interested, you just can visit the links in the slides that I will provide you later. Okay, now next we turn to specifications of the exchange traded options. Since options are traded in organized exchanges, then the specifications of the contract are set by the exchange itself. So one of these specifications is that when the option will expire. Now, in the Chicago Board Option Exchange, the expiration date, the exact date on which the option will expire, is the third Friday of the expiration month. What does this mean? So if an option is going to expire, let's say in April, we have to look at when or what is the date of the third Friday in that month. So in April, the third Friday is going to be the 16th. So which means that the last day the option will be traded is going to be on the 16th of April. Let's take, for example, May. If the option month, the expiration month is May, then we look at the third Friday, which is the 21st, and so on. So for the current month, for example, we are in February, the third Friday is going to be the 19th. So which means that if the expiration month is February, then already the expiration date has passed and the option is now expired if it expires on February 2021. Now, in terms of the availability of expiration dates or expiration month in exchange traded options, now for options, there are no expiration date or expiration month every month of the year. The exchange will determine what is the expiration month depending on what is the cycle on which the underlying asset belongs to. What does this mean? Now, we have three cycles, three major cycles. So just a second. So these cycles are starts with January or February or March. Now, for options that belong to the January cycle, it means that there will be an expiration month in January, April, July, and October. Now, if the option belongs to the February cycle, then there will be options with expiration on May, August, and November. Finally, if an option an option on a certain underlying asset belongs to the March starts with the cycle that starts in March, then there will be options that expire in March, June, September, and December. Now, are only these the expiration month that we will observe for an option in a year? The answer is no. They have a rule, and this rule could vary from one option exchange to the other. So, for example, they were saying the current month and the following month, and then the next month in the cycle. So that is, for example, one possible rule they will follow to determine what are the expiration months available for the option. Now, in terms of the strike price, also the strike price is determined by the exchange itself. So there are no so the strike prices are not determined arbitrarily. The difference between each contract and another depends on a tick size, and the tick size depends on the range of the underlying on the range of the strike prices. If the strike prices are between 5 and 25, then between each contract and another there will be a 2.5 difference in the strike price. If the range of strike prices is between or higher than 25 and 200 or below, then the range of possible strike prices will change by an increment of $5. If the strike price is over 200, then each contract and another the tick size will be 10. Let's take a real life example to examine how this affects the availability of contracts with different strike prices. Here we are looking at the option chain that belongs to options on Tesla stock. So the underlying is Tesla stock, and we have call options, we have put options, and here we are looking at near the money options. So we're not looking at the whole available options. when these options will expire. They will expire on February 26. So what do we see here? We see the prices. So if you want to buy the option, you will pay this price, and if you want to sell you will pay this price, and if you want to sell this option, you will receive this price. So the ask price is the price at which you will buy the option. The bid price is the price at which you will short or sell the option, and the same for a put option. Now, this price is for all options on Tesla stock? No, it's on options, a call option on Tesla stock with the strike price of 660. If we increase the strike price, then the prices will change, and we will look later in chapter 11 on the relationship between the strike price and the call and put prices. But what do you observe? Now, between each price and another, the prices change, or the strike price changed by an increment of 5. So the tick size is 5. Now, we learned in the slide that the tick size should be 10. Well, sometimes the exchange will find that there is a high demand on a certain stock, on options on a certain stock. So to meet the demand of investors, they might change the rule and offer options with a lower increment. So instead of an increment of 10, it will offer options with an increment of 5. Here we see also options with different expiration dates. So there is options on Tesla stock with the expiration in March, April, May, and June, July. Nothing for August, but there is for September. Nothing for October or November, but there is for December. And then January 2021, and March 2022, and June, and so on. Now you will see here that they did not follow exactly the what we saw in the cycle of options. Well, the one rule that we always have to keep in mind is that there is no rule that markets stick to all over the time. Now the rules we looked at here, it was introduced at the beginning of option trading. Now as the trading developed and intensified, and there is a larger demand from investors, the exchange, the business of making profit, so they will introduce more options, and they will change the rules to meet the demand of investors. Now if we look at all the range of available, so now it doesn't make sense to look at February because February has expired. Let's look at March, for example. So in March, at least 937 different strike prices, and we will see that from one price to another, now the tick size changes by 10, which is what we observed in the rule before. As the option becomes closer to the price, which is 673, then the increment changes to be 5, and that and then it returns back to an increment of, as supposed to change to the increment of 10, it became an increment of 2.5. It all depends on the demand of investors. So at certain point, the increment has become 20. So That's not only for Tesla. If we look, for example, at Moderna, the strike prices changes by $1, so which is not what we saw before. Again, it all depends on what the exchange perceives to be meeting the demand of investors. So if we look at the options available in March, let's see all options. Now depending on when the option are expired, because some options are available with expiration dates on a weekly basis, and these are called weeklies. So the weekly options, it means that there are options that expire every month, every week in a month. So in March there is options that expire on March 5th, and on March 12th, on March 19, and on March 16. So this is a different class of options other than the ordinary ones, which are called weeklies, because in weeklies every week there is an expiration available, or there's a contract that is available to expire on that week. Now if you go longer in the history, you find, for example, in January there are no weeklies, but option available to trade now for next January, and it expire on the third Friday of that month. Here are the specifications of options that are traded in the CBOE. So, generally, what we saw is that the tick size for strike prices are 2.5 when it is between 5 and 25, and 5 points when there are strike prices between 25 and 200. But as we can see, this is not a fixed rule. They can change this if they find that there is it meets the demand of certain investors. Now expiration date, third Friday of the expiration date, and expiration months. Make available 2 near-term months plus 2 additional months from January, February, or March quarterly cycles. And generally also the exercise style are American for equity options. But if we are dealing with options on stock indices, usually they are European. If you're interested, you can check the specifications for equity options on the CBOE. Okay. Now we turn to an important terminology that is related to options, and it's important that you know these terminologies by heart. What are these terminologies? First is the moneyness of the option. Now we can describe an option in terms of what is its moneyness relative to the market conditions at the time we are examining the option. Now, if the option is at the money, it means that the strike price is equal to the stock price today. When an option is said that it's at the money, it means that the strike price is equal to spot price. So it's a situation where K, the strike price, is equal to the underlying stock price, which means that the payoff of this option is going to be 0. we are looking here at the payoff diagram of the option. And when we are looking at the payoff diagram, we are ignoring the premium, the premium paid. So we're not looking at the profit or losses. We are looking only at the payoff. If the option, again, is at the money, so the payoff is equal to 0. Okay? Which means that the investor will be indifferent whether to exercise or not to exercise. In this payoff diagram, we observe that S is higher than K. Now this is K and this is S. So it is a situation where it makes sense for the investor to exercise. So if that's the case, we call this option in the money. Again, an option that is in the money, it means that it makes sense for the option holder to exercise the option, or the payoff will be positive. Now that's not only for call options, also for put options. In this scenario here, we observe that the spot price is lower than the strike price, which means that there is no logic to exercise the option, because in the case of a call option, you can buy the underlying asset at a lower price compared to the strike price. So the option will expire worthless. And if that is the case, S is lower than K for a call option, then the option is said to be out of the money. Again, an option is out of the money if it doesn't make sense to exercise the option, or the payoff will be 0 from the option. So to summarize the moneyness of options, for a call or a put, the option will be at the money if K, the strike price, is equal to the spot price, the current spot price. If the option is in the money, or the call option will be in the money if K, the strike price, is less than the current spot price, and for a put option it will be in the money if K, the strike price, higher than the current spot price. The option will be out of the money in the case of the call if K is greater than S, and a put option will be out of the money if K is less than S. Now, options are referred to by the ticker of the underlying, the strike price, and the expiration month, and what is the option class. So these are the important characteristics for any option series. Finally, we need to keep in mind an important definition for option values, which is the intrinsic value. Now, the intrinsic value, it is the value of the option when there is no time to maturity. So basically, for a call, the intrinsic value is the maximum between S minus K or 0. And for a put option, it is the maximum between K minus S and 0. Now, one of the simplest decompositions of the option price, so the option that we observe in the market, is to decompose it into two parts or two elements. One is called the intrinsic value and the other is called the time value. The intrinsic value for a call option is the maximum between the current spot price minus the strike price, or zero. So if the difference was negative, then the intrinsic value will be zero, because there is nothing that forces the holder of the option to exercise. And for a put option, the intrinsic value is the strike price minus S, the current spot price, or zero, whichever is the maximum. If the difference is negative, then the maximum will be zero, so that will be the price of the put option. Now, the other part is called the time value. The time value of an option is the difference between the option value and its intrinsic value. When we compare the actual option prices compared to the intrinsic price or the intrinsic value, we will see that there is a difference. This difference is this difference belongs to the time value. Now what's the time value exactly? The time value will take into account the possibility that the stock price will increase higher than to its current level. What does this mean for the call option holder? It means that the payoff of the option will be higher. Not only it reflects the fact that the stock price will increase, but it will reflect that the stock price will change in a larger magnitude. So it will either increase by a large movement or decrease by a large movement. And if that's the case for a put option also, it means that there is a possibility that the option will expire with a higher intrinsic value. And for a call option, it also means that it is possible for the option to expire with a higher intrinsic value. Now, as we come closer to the expiration date, so this, let's say the time, this is the time, and this is the time value. As we come closer to the expiration date, the time value will decay until on expiration date itself, the time value will equal to exactly zero. At any point in time before the expiration date, the time value will be positive. However, it is impossible for the time value to be negative. So it could be zero or positive, but never negative. Now, next we will discuss the effect of cash dividends and stock dividends and stock splits on the option contracts. Now let's assume you have N options with a strike price of K. If a company declared cash dividends, nothing will happen to the terms of the option contract, because part of the risk that, or part of what investors are exposed to is the movements in the stock price, and whether it is because of the cash dividends or something else. The only case in which it will be not fair for option holders to keep the option terms unchanged is if the company declared a stock dividend or a stock split. Now, a stock dividend or a stock split, will it affect the fundamentals of the company? Again, if a company declared stock dividends, is the market value of the company going to change? Logically speaking, no. They just moved some funds from one account to another account, and they issued new stocks to reflect the new stock issued as dividends. If the company split the stock, so instead of the face value being 10, it made it to 5, for example. Is the market value of the company is going to be different? Again, logically speaking, no. So it should be fair for the holders of options to adjust the terms of the option to reflect the changes in the option contract. To reflect the changes in the that happened to the stock as the result of a stock dividend or a stock split. Now, if we are facing with an N for M stock split, so every holder of M stock will receive N stocks, then we have to change the strike price to be M times K divided by N, and we have to change the number of options to increase to be N times the number of options divided by M. Stock dividends are also handled similarly to the stock split. Let's take an example. Consider a call option to buy 100 shares for $20 per share. How should the terms be adjusted if, let's say, we are dealing with a 2-for-1 is too simple. Let's say a 3-for stock split. So to proceed, let's agree on the notations. The capital N for us here is 100, and K is equal to 20. Small n is equal to 3, and M is equal to 2. So the new strike price is going to equal to M times K divided by N, which equals to 2 times 20 divided by 3. And this should give us 13.33. So the new strike price will be reduced to 13.33. Okay, how about the new number of shares or number of options included in the contract? It equals to N times capital N divided by M, which means 3 times 100 divided by 2, and this will give us 150. So this is how the option contract will change as a result of a stock split. Okay, now if we are dealing with a stock dividend, we approach it the same way we did for here. We can just translate this into an N for M, and we then proceed. For example, now a 5% stock dividend is equal to a 105 or 100 stocks, right? Isn't this true? Every 100 stocks will end up having 105. So, and then we proceed with the same way we did here. So this will be our N, and this will be our M. So let's do it quickly. In the second case, the new K is equal to 100 times 20 divided by 105, and this will give us 19.05. The new N, new number of options in the contract, is equal to 105 times 100 divided by 100, which will give us 105. Okay, next we turn to the discussion of some aspects related to option trading. In the past, options were traded mostly on exchange floors. So different brokers will meet together to negotiate and reach an agreement, and usually it was very noisy at the floor. It's very crowded. They try to execute or transmit information and execute orders. So it was complex, like what we saw for in the case of futures. But as there has been a lot of technological advances in communication, the vast majority of trading nowadays are made through electronic platforms. So for example, in this CBOE, about 95% of the volume of trades that involves options in the CBOE are executed in the electronic platform. The rest are some complex, are left for complex options that requires skills and of the traders, and they have to meet face to face to be able to negotiate. In most advanced markets or option markets, there are market makers who act as a stability conserver of the option prices. So they will try to absorb large orders on both sides, the sell and buy, to avoid huge swings on the option price. But of course, also market makers, they have their own limits. So if the amount of the order is beyond their ability, then definitely there will be a movement in the option price. But generally, they are required to ensure the stability of the option price. Doesn't mean that the price of the option should not change at all. It should change, within a certain range, and the market maker has to ensure that whenever there is a demand for selling the option, he's willing to take that side. If there is a demand for buying the option, he's willing to take that side. Now, when we are dealing with options that traded in organized exchanges, and let's say you took a long position in an option. Does it mean that you are stuck with the option until it expires? The answer is no. Now, if you can take an offsetting position, which means you can take a short position, then you lose this right. You lose the right in the option, and you don't have any exposure, or you don't have any relationship with the option anymore. Similarly, if you took a short position in an option, does it mean that you're stuck until either the counterparty will exercise or until it expires? The answer is also no. If you are able to take an offsetting position, which means you take a long position, then you can exit from this commitment and you will not have any obligation anymore. And this is the advantage of trading options in organized exchanges, is that you have the ability to exit before the expiration date from your position. Now, next we will discuss a little bit about commissions and margin requirements that are related also to trading options. Now, we know that at least traditionally, trading options or any other types of instruments involves cost. So, and the cost depends on the type of broker you're dealing with. So if you're dealing with a discount broker, you will be charged only commission for executing orders. If you are dealing with a full service brokers, you will pay a higher commission, but you will get additional services like access to their research reports. You might be able to get some advices and so on. Now, we have to keep in mind when we are dealing with options that when options are paid, when a commission is paid. Now, you will pay a commission when you take an option position and when you close the option position. So you took a long, you will pay commission. You took an offsetting position and you took a short position, you will pay a commission. Now, if you keep it until the maturity of the contract and you exercise the option, then you will pay commission for exercising, and you will pay commission for selling the stock or buying the underlying asset if you want to take advantage of the differences in the price. So, for example, you took a long position in Apple stock with a strike price of 500. On the expiration date, you found that the stock price is 600, and assuming that the option is a call option, you decided to exercise the option. So you will pay commission for exercising. Now, you will receive the stock, and your intention is not to keep the stock. Your intention is to sell the stock. So when you sell the stock, also you will pay commission. Is there any other cost associated with trading options? Let's examine here call options on AMC Entertainment. If you want to buy the option, let's say a call option with a strike price of $7, you will pay 2.5. If you want to sell the option, you will pay 2.34. So what do you notice? Let's assume you bought the option, and right away after you bought the option, you decided, no, this is a bad investment, let me exit before any large changes in the price will happen. So you will sell at 2.34. So did you lose here or did you gain? Exactly, you lost at least 1.6. This is the difference between the bid-ask spread. So we have to keep in mind that the bid-ask spread is also considered as a cost for trading. Whether you are trading options or stocks, it's always a cost, a part of the transaction cost associated with trading. Let's take an example. This table here is for a commission schedule that a discount broker charges for trading options. Now you can see here that based on the value of the transaction, the commission or the way the commission is calculated is going to be different. In addition, sometimes the brokers, they assign a certain commission for first transaction or first series of transactions. For example, here the minimum commission is 30 per contract for the first contract, plus $2 per contract for each additional contract. So once you place a new commission, a new order, for the first order, there you will be charged 30. And later on, based on subsequent transactions, this is the schedule that applies. Now, this is not fixed. It changes or it differs from one broker to another. So we will not really learn about a certain commission schedule. We will just learn how to calculate the commission given a certain commission schedule. Let's take an example here. Consider an investor who bought a one call option contract. And remember, a one call option contract is a bundle of 100 options, because exchange traded options are not traded in arbitrarily. The exchange itself determines the size of the contract. So the size of a contract in the Chicago Board Option Exchange, for example, is 100 options in each contract. The option price is 4.5. So one option costs 4.5. Not one option contract, one option included in the option contract. And the strike price in this contract is 15. So how much he will pay. And we also want to look at if the stock price became 60 and the investor decide to exercise. Now here, let's assume that the schedule set by the broker is that if the investor decided to exercise and sell the stock, he will pay 0.75% for each step. How much will be the investor's profit? Let's look at the example. Sorry. So now the contract cost will be 4.5, the option price, times 100, because each contract includes 100 options. So total will be 415, an amount that will be paid by the investor. And the commission, according to the schedule, is going to be $30. So net, the investor will pay 480. Now, when the investor exercises, he will buy the stock at 50. So he will pay 5,000. And then immediately or simultaneously, he will sell the stock at 60. So he will buy it from the short party and he will sell it in the market for 60. So he will receive 6,000. So net, he will receive out of exercising 1,000. The commission he will pay is going to be based on the stock price 60, because he submitted the order to exercise when the price was 60. So the commission will be 2 times 0.75% or 0.0075 times 60 times 100. So total commission will be 90. So the net profit out of this transaction, he received a payoff of 1,000. How did we get the 1,000? It's the difference between the selling price of the stock and the buying price of the stock, times 100 minus 450, the commission, the contract cost, the premium he paid, minus 120. 120 is basically the commission he paid when he entered into the contract, and the commission he paid when he exercised the option. So net profit is going to be 430. Now you can see that the transaction cost associated with trading options is not trivial. It's a significant amount. So to reduce the profit or the revenue from 1,000 to 430. So we have to add the cost of the option itself and the commission associated with trading the options. Now we turn to the issue of margins. Investors who take a short position in options are required to maintain a margin in a margin account. And the reason for this is what? Now, if you remember, the holder or the buyer or the long investor has the right. However, the writer or the seller or the short investor has an obligation. So since the writer has an obligation, there is also the possibility that either the short investor will default or will refuse to execute the contract. So there is a credit risk associated with taking a short position in options. Why? Again, because the short investor has an obligation, while the long investor has only the right, because he already paid the premium, so his commitment in the contract has been already delivered. But the commitment of the counterparty, the writer or the seller of the option, is always that is associated with uncertainty. So to reduce the risk associated with the short investor, exchanges require from short investors to maintain a margin account. Now, how the margin is calculated? Now, we have to keep in mind that a margin is required when we are dealing with what's called naked options. Naked options means that the option is not covered by something else. So if we created a position in which the options are naked options, then the margin is determined by taking the greater out of two calculations. The first calculation states that we take 100% of the proceeds of the sale plus 20% of the underlying share price less the amount, now, and if any, by which the option is out of the money. So there will be only a reduction of the amount that we calculate here if the option is out of the money. If the option is in the money, then we don't do any deduction. The second calculation is based on a total of 100% of the proceeds of the sales plus 10% of the underlying share price. If the option is called, 10% of the exercise price if the option is put. Now, if the investor is engaging in different trading strategies, there could be also special rules. So let's take an example. Assume that an investor writes 4 naked option contracts. The option price is 5. The current stock price is 38. And the strike price is 40. So S0 is 38, K is 40, and the option we are dealing with is a call. How much he must deposit as a margin? To determine this, we look at the greater amount out of 2 calculations. The first calculation is 100% of the proceed of the sale. Now, how we calculate the proceed of the sale? The investor wrote 4 naked option contracts, and each option contract includes 100 options. So we multiply 4 times 100, so we have 400 options, times the proceed sale, which is the premium. Now when the investor writes an option, he will receive the premium. So the premium for him is going to be considered as an income. And we add to the premium 20% of the underlying stock price, which is 38. Now, if the stock price is 38 and the strike price is 40, is the option in the money or out of the money? Remember, we are dealing with a call option. Yes, it is out of the money. Why? Because it doesn't make any sense for the long party to exercise, because the price of the stock is 38 while the strike price is 40. And whenever you are buying something, you want to pay a lower price, the lowest possible price for it. So instead of exercising and buying it at 40, you will buy it at 38 from the market. So the option is out of the money. By how much the option is out of the money, we take the difference between K and S0, and we find it equal to 2. So again, 100% of the proceed of the sale, which is 4 times 100, times 5, the option price, plus 0.2 or 20% times the current stock price, minus by how much the option is out of the money. And we will get, for this first calculation, 4,240. So 4,240. For the second calculation is 100% of the proceed of the sale plus 10% of the current underlying stock price if we are dealing with a call. If we are dealing with a put, it's going to be 10% of the strike price. So 5 plus 10% of the current stock price, and that will give us 3,520. Now, which amount will be considered as the requirement for the margin? We take the greatest, so the investor has to deposit 4,240 in the margin account. Now, if the option we are dealing with is a put option, then we have to do the calculations again, respecting the rules for each one of them. For the first calculation, it's 100% of the proceed of the sale, which is, so in our case, 4 times 100, so 400 options, times 5, which is the option price, plus 20% of the underlying stock price. And since the option is, if the option is put and S0 is less than K, then for a put option, the option is in the money, it's not out of the money. So we will not deduct anything out of it. And this will give us, for the first calculation, 5,040. For the second calculation, it's going to be 100% of the proceed of the sale plus 10% of the strike price. So see here in the stock, if the option was a call, then it's the 10% of the stock price. If the option is put, in the second calculation, it's 10% of the strike price, and will give us 3,600. So what will be the amount the investor will deposit if the option is a put? 5,040. We end our discussion of chapter 10 by briefly examining different types of options. Now, one different type of ordinary options is called warrants. And warrants are usually issued by corporations or a financial institution. Now, how warrants are different from ordinary options? Let me ask you this question. Let's say one investor has an option to buy 100,000 stocks of Apple stock. If he exercised the option, will this transaction affect Apple in one way or another? Is it going to change the fundamentals of Apple in any way or another? Well, the answer to this is no, because Apple is absolutely not involved in this transaction in any shape or form. It's only at this 100,000, the transaction that involves 100,000 stocks of Apple, it's between two parties, and Apple is not involved in this transaction by any way. So even if the number of options that are exercised 1 million, 10 million, it doesn't matter. Now, Apple will not be affected, or the fundamentals of Apple will not be affected by this transaction. In warrants are different. Warrants, when they are exercised, they require the company that issued them to issue new shares and transfer it to the holder of the warrants. So the number of warrants, the warrants will affect the number of shares outstanding. Okay, so this is a fundamental difference between warrants and ordinary options. Usually, warrants are used as a way to motivate employees or the executive management to put effort to increase the price of the stock. So the higher the stock price, the more payoff they will get out of exercising the warrants, and this way their incentive is aligned with the incentive of the shareholders. Now, usually when warrants are issued, they are issued at the money, and when they are exercised, the cost of issuing these warrants are considered as an expense that will be taken out of the income statement. Next, we turn to convertible bonds. Convertible bonds are similar to a regular bond, except it also has an embedded option in it. And this option is a call option to buy the stock or to convert the bond into an equity. So this convertibility is considered as a call option on the current stock price. sorry, on the company's stock. So when we want to evaluate a convertible bond, we cannot use the technique we use for ordinary bonds to find its value. We have to also consider the price of the option embedded in the convertible bond. So that's one also important reason why we are learning options. And maybe some will say, well, the options are not available, for example, in Saudi Arabia until now. So why we are doing this? Well, now there is a movement towards accepting new forms of financing, like preferred shares or convertible bonds. So to be or to match the advancements that happening in the market, we also need to learn these types of techniques that involved with valuing new instruments or new securities that are introduced to the market. With respect to a convertible bond, sometimes the issuer of a convertible bond will also make them callable. So he has the right to call the bond before its maturity date. And usually they do this to give, so the issuer will have the flexibility to mature or call back the bond issue if the conditions in the market motivates the issuer to get back the old issue and issue a new one at a lower coupon rate. So let's say, for example, Microsoft issued a convertible bond when interest rates was high, around 6%, 7%. Now, nowadays interest rates are close to zero, so it's very low. So if Microsoft is going to issue a new convertible bond, it will issue it at a lower coupon rate. So to take advantage of these changes in the interest rate, in the environment of interest rates, Microsoft will call the old issue and then issue a new one at a lower coupon rate. So also this callability feature of a convertible bond also has its own cost. So when we are trying to value a convertible bond that is callable, we have to also take into account how to calculate the callability, the cost of the callability of the option. That's it for our discussion with chapter 10. I hope you will find it useful. Thank you for listening. Assalamu alaikum.